Hello, everyone. In this session, we would look at the difference between how a taxpayer account for revenues and expenses, whether they chose the cash method or they chose the accrual methods. It makes a difference how the taxpayer is taxed. So we need to understand the rules. When is revenue taxed under the cash method? It means cash method means you receive the money. You have to pay your taxes, or when it's taxed under the accrual method. And the same concept apply to expenses. You have to be familiar with when does an income or a deduction takes place, because a taxpayer could be a cash taxpayer or could be an accrual taxpayer. The method that they choose makes a difference to the timing of their taxes. This is what we will discuss in this session. You want to make sure you're familiar with these rules. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with revenue. Under the cash method, it's pretty straightforward, very simple. If you receive the money, then it's revenue because the IRS wants their share. So if you receive the money, it means you have the ability to pay. You're using the cash method, it's taxable. It's a straightforward. If the payment is in your hands or constructively available to you. Let's assume someone transferred money to your bank account. Well, it's not in your hands, but it's in your bank account. It counts as income. Or someone mailed you a check, but you chose not to cash the check. That's still money in your hands. So if you have not deposited that check, that's your choice. It's still considered received. Now, under the accrual method, it's a little bit more complex. Income is recognized either when it appears in the financial statements. So if you're using the accrual method on your financial statements and that income appeared on the financial statement, then you have to report that income under the accrual method for tax purposes. Simply put, you cannot look good, in quote, show the revenue on the financial statements. Remember, the financial statements follow GAAP, and here we're looking at the IRS rules. If IRS for tax purposes. So if you show it for GAAP, you have to report it for tax, or when the all events test is satisfied. Now, what is this all event test? It's a two-part test. First, you have to reasonably estimate the amount of the revenue. The amount of the revenue has to be known, and you must be entitled to the income. How would you be entitled to the income? Well, here we go. You build the client. So when you build the client, it means you have the right to the money, because you cannot bill someone without performing the work for them. That's the logic. If someone sends you a bill and says, pay me, and you would say, you didn't do the work yet, well, that doesn't happen, right? So if you can build the client or you build the client, then you satisfy that test, or you actually perform the services. Usually when you perform the services, you are going to bill the client, or the client actually paid you. And even if the client paid you in advance, again, it's money in your pocket. You have the ability to pay your taxes. How about unearned revenue? Because here we're going to go back and talk about receive the payment. If you receive the payment, it means it's revenue. Unearned revenue is when someone pays you before you perform the service. Well, if you're using the cash method, well, for unearned rent or interest income, the rule is simple. So if someone pays you, if you own a property and someone prepaid their rent or someone prepaid their interest income, pretty straightforward. You receive the money, you pay the tax. Same for goods and services. If someone pays you up front for goods or services, you have the money. Although you have not earned it because you did not do the work, it's taxable. This is for cash. For accrual, for rent and interest, the same principle applies. So if someone pays you up front for rent or interest, if you're using the accrual method for tax purposes, you have to do what? recognize it as income. Even if you are using the accrual method, unearned revenue under those circumstances for rent and interest is taxable upon receipt. Now, for advanced payments for goods and services, a little bit different. There's a wiggle room here. You can elect, you can choose to defer to the following year if not earned by the end of the current year. So someone pays you something up front for year one, but you're not going to complete the work until year two, then you can defer some of that to year two. So you have that wiggle room. How about expense recognition? Well, under the cash method, you can recognize the expense when you pay it. That's why it's the cash method. You pay it, it's an expense. Now, bear in mind, we have few exceptions for inventory. We have a whole session about inventory, property, plant, and equipment, long-term assets. We'll talk about those shortly, but inventory, we have a whole session. Under the accrual method, the all event test and economic performance test must be satisfied. All events test, the cost must be incurred and you must have an obligation to pay. So someone serviced you and you have an obligation to pay them. Obviously, no one's going to service you if there's no agreement, but it has to be there. So someone provided a service or you use their services and you're obligated to pay, and the service or goods must be provided to you. This is the economic performance. They perform the service, economic performance. Now, bear in mind, for expenses, those are the general rules. We're going to have special rules for specific expenses. And we're going to look at tangible and intangible assets. Usually those are long-term, prepaid business expenses, prepaid interest expense, and bad debt expense. Those are basically special rules. Starting with tangible and intangible asset. Here we're looking at property, plant, and equipment, long-term tangible asset, and intangible assets, copyright, anything that lacks software license, anything that lacks physical existence, but serve you for several years. For tangible asset like property, plant, and equipment, it does not matter whether you are using cash or accrual accounting. You must capitalize and depreciate those over time. So when you buy a vehicle, when you buy a building, when you buy a truck, in the absence of using special depreciation method, the rule is you have to capitalize it. The same go for intangible assets, which need to be capitalized, but intangible asset we amortized. For prepaid business expenses, if you are a cash method taxpayer, prepaid are generally deductible immediately unless the contract exceeds 12 months or extend into the third tax year. So what does that mean? It means usually you prepay for business expenses, it's good, you can expense it. If it exceeds 12 months or extend into the third taxable year, you may not be able to expense it. For accrual, the all event and economic performance tests apply, as we talked about them earlier. However, there's an exception known as the 12-month rule, which allows accrual taxpayers to deduct prepaid expenses in full in the year if the benefit does not exceed 12 months after the end of the year. So you paid for 12 months. Here, this is year one, and the service goes from year one, and this is year two. It doesn't extend beyond year two. You can go ahead and expense. Prepaid interest expense. So notice we treated prepaid interest separately. Why? Because you cannot deduct prepaid interest until it actually accrued. It means the time has passed for interest. For it to accrue, time will pass. And this rule would apply to both cash and accrual. So you cannot prepay your interest and take a deduction. You have to wait until you accrue the interest on that loan. Bad debt expense. Well, for a cash method, you cannot have a bad debt expense. Why? Because remember, to have a bad debt expense, it means you recorded a sale, debit account receivable, credit sales. Well, for cash taxpayers, we don't have this entry. We don't have debit account receivable, credit sales. So you cannot deduct something that don't exist. It means you don't have accounts that are collectibles. Now, for accrual, the direct write-off method is used. You can deduct bad debt when you determine they are uncollectible. Now, when you do so, when you have under the accrual method, you do have debit account receivable, credit sales. That's part of the accrual, $10,000, account receivable, $10,000 sales. Then what you will do, you would say, okay, once I determine that this account receivable is uncollectible, I can debit bad debt expense, 10K, credit the account receivable for that client, 10K, whoever that client is. So you can deduct, but using the direct write-off method, you cannot estimate. And the reason I emphasize this, because when we learn about financial accounting GAAP, we learn about the allowance method. And under the allowance method, you can estimate bad debt. And it's called the allowance method. And when I do cover the allowance method, I mention that the direct write-off method, this is the direct write-off method, is used for tax. But the allowance method, the allowance is used for GAAP, this is a tax course. What should we do? We're going to have to work an example with actual numbers to illustrate what we talked about in this session. What should you do? You want to go to Farhat Lectures, look at additional MCQs, look at additional exercises that's going to help you, whether you are an accounting student, CPA candidate, enrolled agent, studying for some professional certification, or your tax courses. Invest in yourself. Good luck, study hard, and of course, stay